Another day, another stock market beatdown. The red continues. It's been one of the ugliest weeks we've had in quite some time. In fact, the S&P 500 traded below its 200-day moving average for the first time in several months here today. The Dow Jones was down over 2% today, which now has a strongly bearish posture, not just a weakly bearish posture. So it's joining the other three U.S. equity indexes from that perspective. And the Russell 2000 saw its third straight oversold cluster signal on the market forecast indicator. So a lot of different things going on. There is one area of the market that seems to continue to capture some of investor interest. And so I want to concentrate our trade application example on that particular area here today. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's October 11th, 2018. First of all, for those of you that are new, welcome. Thank you for joining us here tonight. You can subscribe to our YouTube channel, and while you're there, go to our description area where you can see a link to sign up for our email distribution list, which will entitle you to not only finding out when these videos get posted, but also letting you know which stocks are giving you overbought and oversold cluster signals in the S&P 500. I imagine there's going to be a lot of oversold cluster signals in the S&P 500 in today's email. In addition to YouTube, we're also heavy users of Twitter. My handle is @BrandonVanZee, all one word. Feel free to follow me there. And if you get value out of these daily videos, make sure you click like and retweet to let us know that you appreciate them. In addition to that, we also have a Facebook group established. You can see the web address embedded in the logo there in front of you. All right, with that, let's go ahead and dive into the analysis here today. As you can see, I do have chart 4B pulled up in front of us. So for those of you that are premium Market Scholars subscribers, you can always follow along with David and I's presentations and know what chart we're on there. So this particular chart setup is just a 4 grid that'll show us the 4 major U.S. indices and kind of how they're all doing side by side by side. Well, right now we're starting to see they're all kind of correlated to a degree because, as I mentioned in the intro, the Dow now has that strongly bearish posture. You notice that before today, we had that lighter pink background color. Now it turned into this darker pink. So it joined the other indices from that perspective. Remember, the Russell 2000 was the first one to give us that strongly bearish posture. And looking back, we can now see that that was kind of the leading group of companies, as it often is. Remember, the Russell tracks the small cap companies, Russell 2000. And so the theory goes that they're a little bit more easy to push around, a little bit more easy to be manipulated. And so investors and big money can push them up and down very quickly. And sometimes they do give us a sign as far as where the market might be heading. And so Russell 2000 this time around certainly did drag the rest of the market down with it eventually. Now, as you can see, speaking of the Russell 2000, down here, we were down 1.91% on the Russell 2000 today, and we completed our third straight cluster signal. So there's 3 little green dots down there in the low reversal zone. In fact, let me do this. I'm going to right click and go to maximize cell, so that way you guys can see them a lot easier there. So there's 1, 2, 3. And you can see them on the chart up here as well, 1, 2, 3. And what those identify are times when the security in question, whatever one's pulled up on your chart, is deemed to be oversold. Now, just out of curiosity, I'd like to go back and see how many times have we had 3 straight cluster signals like that, where we have the blue, the red, and the green in the lower reversal zone on the same day. So you can see there's not been any time like that on the chart. This only goes back 3 months here. So let's go back a bit further in time and see if we can see any other instances where that may have occurred. Let's go back to a 1-year daily chart and see if that ever occurred. Nope, didn't happen any time in the last year. Let's see if we can go back even further than that. I have no idea if we will. Maybe this is something that's never happened before. Let me go to a 5-year, but I will have to then switch it over to a daily candle just so we're comparing apples to apples here. Whoops, what did I do? Sorry about that. Go back here to 5-year. Actually, I'm going to do this. I'm going to click on time frame right here, and I'll just set up my own. So 5-year daily, that'll work. There we go. And it does look like there may have been some instances of that type of behavior in the past. Let's go back here to August of 2017 and see if that occurred there. It did. So let me kind of I'll zoom back out here again, and then we'll zoom back in just so you guys can see that. It does look like it occurred over here in October of 2016 as well. So maybe I'll zoom in on that area to see if we can look at them together. And as you can see, this was the set of 3 clusters that I mentioned before, which was August of 2017. This was the other set of 3 clusters in a row that we saw back here in November of 2016. So as difficult as it is to think that the stock market is going to rebound here, one thing that we have noticed is that when we get extreme sell-off prices like we have this week, that the end could be near. Now, obviously, no technical indicator is 100% perfect, but I guess if you just ask yourself rationally, if you had the opportunity to go back in your time machine and go back to this period right here, or go back to this period right here, would you rather be a buyer or a seller of the Russell 2000? And I think most of you would probably say you'd rather be a buyer because clearly the stock market rallied very shortly thereafter. Now, we don't know if that's going to happen again now that we've gotten 3 in a row here, but it does suggest that we have gotten to some extreme levels. It's not just, hey, my gut is telling me that the sell-off is pretty strong. There's actually technical evidence here to kind of support that idea. So keep that in the back of your mind, as you're looking at your various trade setups that are out there. Now, just because we've got these oversold cluster signals, and if you expect some sort of a reversion to the mean, doesn't necessarily guarantee that it's going to change the trajectory of the overall chart. Maybe we just go up for a week and then we spill over again. But it's just a reminder that now that the dam has broken and the water is spilling out, it's a little bit more difficult now to take bearish trades at this level unless you think something just absolutely extraordinary is about to develop on the other side. So it's not that it's a terrible idea to take bearish trades. It's just that now that so much technical damage has already been done, that maybe you decide that your position sizing is a little bit smaller than it would have been otherwise. Some of you might have been taking those bearish trades over here when the Russell 2000 first was giving us this bearish posture. That makes a little bit more sense to be a little bit more aggressive as it was trading closer to 1700 there. But we've just bled off 150 points now. So if you're finally waking up today and saying, geez, I wonder if I should go take some bearish trades, then you have to keep that in the back of your mind as well. All right, the other things I wanted to discuss on this particular chart setup was just the fact that the Dow Jones was down 2% here today. So that was a very aggressive day for the Dow Jones. We also saw the S&P 500 down 2.06% today as well. You will notice that we had a long lower shadow, and so hopefully there was some buying pressure near the end of the day rather than just saying that we had a market in a free fall. Yesterday was kind of one of those days, right? We closed near the low of the session yesterday. That's not necessarily a good sign for the next day's opening. But when you have a market that goes down but does not close at its lows the way that we did here today, perhaps there is some reason to expect that tomorrow's opening won't be quite as ugly as today. And so we'll just have to keep our eye on that. But what a lot of traders look for in these types of situations is just like a wipeout type of event. And you can kind of take a look at like volume and different things like that to kind of get a sense of whether we're near that. But another thing is what I mentioned before, where we get some of those long lower shadows that gives you the impression that the buyers weren't just rolling over and letting the bears walk all over them. There could be a rally in store. So anyway, take a look down below on the NASDAQ before we leave as well, and notice that they also have a oversold cluster signal. But in this case, it's only 2 days in a row rather than 3 days like we saw out of the Russell 2000 there. So let's take a look at a few other charts here. Let's go over here to chart 4D in this case. Since today is Thursday, it's near the end of the week. Remember that this candle is a weekly candle that we look at on this particular setup here. And each one of these charts are 3 years in length, just to give you some background on the charts themselves. And what I wanted to point out here is what I kind of hinted at in the intro here. The S&P 500 came down and actually traded below its 200-day moving average today for the very first time since we had kind of a little spillover here in March time period earlier this year. So, we've gone a good half a year since we've seen the S&P 500 touch its 200-day moving average. Well, not only that, but you'll notice that the Russell 2000 down here in the lower right-hand corner, it not only traded below it, but it closed well below it. I mean, at least with the S&P 500, you're holding out some hope that, hey, perhaps the long-term investor who likes to buy stocks when the market hits its 200-day moving average will step in here. And I should step back a second here as well and remind those of you that are watching that this blue line here on these charts represents the 40-week moving average, since we're using a weekly candle chart here. But if you were to convert this into a daily candle chart, it's the same thing effectively as a 200-day moving average. So anyway, just be aware of that. So when I say the 200-day moving average is the same thing as you hitting this 40-week moving average here in the blue. But at least the S&P 500 is sitting right there. It's kind of staging a riot at that level, and the picket signs are up, and they're walking around the building, and they're trying to determine whether the bulls or the bears are going to win this battle. Russell 2000, it almost looks like the bears have already won. Now, we're not quite there yet, but when we see price action this violent to the downside, we expect that the prior trend will continue to that degree, unless there's some other news. Remember, there's been some news today that, potentially President Trump and President Xi in China are going to get together. And so you never know when some of these news items will come out of nowhere and change the trajectory once again. But knowing what we do know right now, this is not a good sign, because we traded so far below that 200-day moving average on the Russell 2000. Notice that as we look back over the last several years, we have not traded this far below that blue line since going way back here when we actually had a bearish posture on it, which would have been way back in early 2016. Since then, you've had a very good run out of the Russell 2000, just like you have with all of the indices. But this is starting to look like it wants to cross. And what I mean by cross is the orange line here, which represents the 10-period exponential moving average, is now wilting very, very quickly and appears like it wants to come down and cross below that blue line. So if that does occur, this chart will turn from green right here to a pink color like it shows over here, to signify that from a longer term perspective, we have a bearish posture using this 1040 crossover method. Now remember, this line down below that you see here, this is the MACD2 line. This is effectively telling you the distance between the orange line and the blue line. And so if this black line right here comes down and touches this zero line that's represented by pink down here, it basically means we're getting a cross of those moving averages there. And you'll notice we haven't seen the averages this close to one another since going back to about this time period right here in April, when the orange line was awfully close to the blue line, but it bailed itself out and went higher after that. But look at the difference in the candlesticks at that time. At that point, those candles were clearly above those rising moving averages. At this point, this candlestick is clearly below these moving averages. And so I think it's a little bit more nerve-wracking that a legitimate crossover is a possibility here with the Russell 2000. And, judging by what we see on the board in front of us right now, it sure looks like if any one of these four indices is going to cross, it will be the Russell 2000 that does it first. So that could happen as soon as, the next month or the next four candles from a weekly perspective plotted on here. So keep your eye on that. Pretty ugly action, and we haven't seen that in quite some time. It's been a generally rosy outlook for bulls over the last 2.5 years, as you can see by these charts. But right now we are starting to see some deterioration there. Let's take a look at a few more charts. Let's go on over here now to chart 4E. This is our Intermarket Analysis 12 grid. And as a reminder, the background colors of these particular charts signify whether the market forecast intermediate term line would be considered bullish or bearish at this juncture. And so this is chart 4E for those of you that are premium market scholars following along at home. You'll notice one of the big stories of the day was the VIX. The VIX has exploded higher. We're now sitting at 25 on the VIX. Now, that needs to be, set in context as well. We have to remember that in 2008 and 2009, the VIX hit 90 at one point. So 25 is still very, very low compared to the true chaos that we saw back in that bear market. But it is true that 25 represents by far and away the largest reading of the VIX in the last several months. This is a 3-month view that we're looking at here. Volatility is back. And remember, some of you may fear that. Others may say, thank goodness, it's about time, right? Some of you are option sellers and you've been waiting for juicier premiums out there. Now you're finally getting an opportunity to see some of those. You'll notice that the Treasury yield has been a big story here recently as well. Interest rates surging has been what a lot of market pundits have kind of blamed on the demise of the stock market here recently. Well, that can be self-correcting to a degree as well. And what I mean by that is when equity investors get very nervous about interest rates spiking because they fear that that will lead to smaller profits from the stocks that are running the businesses within the stock market. Well, sometimes the whole stock market can get skittish. And when the whole stock market gets skittish, oftentimes money starts flooding from the stock market to other asset classes. And one of the other asset classes where it goes to is U.S. government bonds. After all, that is said to be one of the only risk-free asset classes out there because assuming the U.S. government does not go bankrupt, there is no default risk when you're investing in U.S. treasuries. They will give you back all of your money if you bought a true treasury from the government and will pay you interest along the way. So a lot of times when the stock market really crumbles, like we've seen here recently, we see money kind of coming out of the stock market where it is perceived to be at risk and goes into less risky areas like the bond market. And that is what we are now seeing. Notice that TLT was up 1.22% today. And remember that bonds and interest rates move inversely from one another. So when investors are getting out of the stock market, getting into the bond market, interest rates are going to fall when that takes place. So as bonds were going up here in the last few days, notice that interest rates are now falling. Now, we haven't broken that uptrend or anything like that, so I don't think this is the end of the story by any means, but it is a reminder that if the thing that caused the stock market to fall violently was rising interest rates, it's almost correcting itself right now by having money flood back into bonds, which then pushes interest rates back down, and then maybe the stock market will finally calm down again, saying, okay, thank goodness interest rates aren't so high anymore. So we'll see if that plays out, but I want you to keep your eye on that because it's entirely a possibility. The US dollar did fall today. It was down 0.55. And so one of the things I hinted at in the intro of tonight's video was that there are some places that are attracting investor attention. In particular, some of those commodities that we've been bringing up in recent presentations is still starting to collect some interest. Now, it's not quite as clean cut of an issue as some may want, but you will notice down below here, notice that gold spiked today. Gold was up 2.93% here today as the US dollar fell. We also saw ag commodities in the form of DBA up 0.23% today. So on a day where, the Dow and the S&P 500 are down 2%, we're actually finding some areas, the commodities, that are attracting some investor attention. Notice that both of those charts are green as well, telling us that we have intermediate bullish postures on them. Now, when I mentioned that it wasn't quite as clean cut, what I was referring to is over here. We have seen crude oil prices starting to fall pretty violently. So where we see some of the metals like gold and some of the softs like the ag commodities doing well, we are starting to see some of that risk premium coming right out of the crude oil market. And we are now trading below this moving average. This is the 30-day moving average on this chart for the first time since going back here to early September. So that's not necessarily welcome news. A lot of times crude oil can be used as a bit of a risk proxy with the idea that a really strong economy that's firing on all cylinders will need to buy a lot of energy. And right now we've seen a little bit of a give back in that particular trade. Let's look at a few more charts. I'm going to take a peek here now at the foreign stock markets and just get a sense of whether the foreign stock markets were able to avoid any of the chaos we saw in the United States today, and the answer is largely no. There were a couple of bright spots. Notice that Russia is doing its best to kind of hold the line there at the 30-day moving average. It was actually up 0.29% today, and India, after just getting taken to the woodshed here for much of the last couple of weeks with all those cluster signals stacking up, it finally caught a little bit of happiness today. It was up 0.32% today. But otherwise, you look at the other charts on the board, all the rest of them are in the red. The only chart that has a green background, which is an intermediate time period, so remember that's a difference than when I say all the other charts were in the red, I meant all the other charts were down today. Brazil was down today. It was down 1.6%, but it is still a green background color, telling us that the intermediate term line would still be considered bullish on this one for the market forecast. So again, for those of you that are intentionally looking for bullish setups and you're trying to find what are the areas that are withstanding the pressures the most of this market, Brazil might be up there near the top of your list. In fact, this would be known as a bit of a breakout retest that we're kind of going through right now. Notice the big gap higher in EWZ right here, and then we pulled back right here. Notice that where we pulled back to is exactly where the old resistance was over here. So a lot of technical analysis theory would suggest old resistance becomes new support. We'll be able to find that out very, very quickly because we're sitting right on that line as it stands right now. So keep your eye on Brazil there. But otherwise, it's ugliness across the board. You know, I saw some tweets earlier today about Germany and other markets that are down over 20% already. Remember, the US is not down to 20%. If it was, we would already be categorizing ourselves as in a bear market. Right now, that is not the case, but there are other areas of the world where that is the case. So really, really ugly charts all across the globe right now. Let's come on over here now and take a look at our sector comparison, actually our sector 12 grid right here. This is going to be chart 4G for those of you following along at home. And it's pretty ugly out there. You can see there's only one green chart left on the board, and that's utilities. And as I was mentioning a couple of days ago, we don't necessarily like it when the utilities are a leadership group within the market because it gives you a sensation that money is fleeing the risk-off areas and trying to seek out safety in some of those other more boring defensive areas like the utilities. So utilities remains, I guess, the stalwart, if you could call it that. Even the utilities were down 1.8% today. So it's not like it's, you know, just ripping higher or anything. It's just that it's withstanding the storm of this market a little bit better than most of the other areas. You know, a lot of talk here recently about how ugly materials has been, and that continued here today. Materials was down another 1% today. When I was with you a couple of days ago, you know, one of the things I was bringing to your attention was the surprising element of energy doing well and materials doing poorly. And I was saying something's got to give. We don't know what it's going to be. Well, we now know the answer. What was giving was energy. Energy probably didn't deserve to be up here at the exact same time the materials were down here. And so we've now seen the energy companies follow suit to the downside along with those materials, as they are some of the more cyclical areas of this market. You know, some of the charts have gotten pretty ugly to the point where perhaps there's going to be a rebound in store technology. Notice we did get an oversold cluster signal here today with today's sell-off. We also got that out of the communications, and then we also got it out of the discretionary. So, you know, keep in mind, like we saw there with the Russell 2000, just because we got one cluster doesn't necessarily guarantee we won't get another one tomorrow. So we have to be careful around that concept, but at least we're starting to see some evidence that you know, some of these charts are getting a little bit too overdone to the downside. So, you know, perhaps there will be a little bit of a reprieve next week. I'm actually going to be on vacation next week, so I hope that's the case. I don't want to be checking my phone every 5 minutes at my stock quote. So anyway, we'll see if that happens or not. But at least we've got some cluster signals right now, and maybe some of those areas, the worst has already occurred. Let's take a look at a few other charts. Oh, and by the way, I like to do this on Thursdays, just in case some of you are watching the Market Outlook video, but you weren't able to attend my class earlier today. Remember, on Thursdays, I teach my question and answer class, so it allows all of you premium market scholars to come in and ask me specifically questions that's on your mind. And so we had a conversation here today about looking for debt-free stocks and how they do during rising interest rate periods. We talked about some stocks that are showing up on the radar screen for dividend growth investors. We talked specifically about ITW. Talked about some trend trading stops. We talked about the comparison of selling puts versus just putting in buy limit orders and using 3M as an example there. We looked at Texas Instruments, which had a pretty robust dividend increase here reported last month. We talked about some of the trends on the S&P 500, talked about how do we make a decision between going with a long vertical spread versus using a short put vertical spread. We talked about some sources I use for dividend growth investing. What else did we talk about? Trading through earnings using options. We talked about how to read the charts, talked about what's causing some of this market sell-off right now and some of the transitions in the sectors out there from discretionary and technology into the new communications sector. Talked about some of the stocks that are on our buy list for our class. And then discussion again about selling puts or just buying stocks outright. So anyway, those are all time-stamped there, so that way you can go into our recording and go directly to the question that you want to listen to. All right, let's take a quick peek at a couple more charts, then we'll get into our trade application example for the day. I wanted to bring up the chart of 4K here, which is the volatility chart. We don't use it a lot, but as I mentioned before, I like to look at this when we have a really aggressive day like today, because I like this little area in the middle here on chart 4K, which will show us visually a different way to see whether we had a 1% or a 2% either up move or down move. Now notice the S&P 500 has touched this orange line on this graph 2 days in a row. So what that is telling us is that this is the second straight day that we've gone down 2% or more on the S&P 500. So similar to what I showed you before with the Russell 2000, I think it might be helpful for us to go back in time and see when was the last time that happened with the S&P 500. And so let's go back. I'm going to come into our time frames here, and let's go back starting with 3 years daily and see if that has happened anytime recently. There was a couple of them that were bunched up right here where that might have happened. Let me zoom in right in that area. Yeah, it's actually happened 2 other times here, somewhat recently. So notice that the most recent time before this last 2-day period was going back here to March of this year, where we had 2 straight days to the downside where we were down more than 2% 2 days in a row. We also had that same thing happen right back here in February. So again, sometimes human memory is quite short-term in terms of what has happened in the stock market. Remember, this may feel like it's a very violent move, and you have every right to be nervous about it and concerned about it, but it is not abnormal. This has actually happened twice in just this year prior to what we're experiencing right now. Once back here in March and once back here in February. Now you'll notice that in February when that occurred, that was the second of the 2% down day. We did have a couple more days to the downside over the next week, but largely that spelled the bottom during that kind of tumultuous period, and we did rise after that. Now when we went to this next one, this would have been the second candle right there, and it's kind of the same thing where we did try to find a bottom and sort itself out for the next week or so before finally going up, and then it was no looking back at that point forward. The market just went up after that. And so again, that's not a guarantee that that's what's going to happen this time, but this is probably not the time to panic is I guess the point I'm trying to make. If we've had 2 days in a row to the downside of 2% each, that is a time when more often than not, historically, is shown you would rather be a buyer than a seller of securities at those levels. One other thing that catches my eye while we're here, I mentioned the VIX was spiking here today. We're up above 25 on the VIX. The other thing I wanted to mention was, notice that we've got our VIX to VXV kind of ratio chart right here, which stands at 1.18%. That is considered elevated levels as well. In fact, it's the highest level as I kind of look at my crosshairs here, going back to this candle way back here in February. So the same thing, and that's what you're looking at with that ratio chart right there is basically looking at how many people are buying VIX right now versus futures contracts of VIX to give you a sense, are people like beside themselves with fear at this exact moment in time, trying to protect themselves at all costs right now without any regard to 3 months from now, which is almost always a higher VIX than it is right now. So when those two things flip, it oftentimes spells part of a bottoming process in the stock market itself. So on this candle right here, it would have been February 9th. It would have been associated with this candle right here. And again, that was near the bottom of that really aggressive move right there. So perhaps that's yet another sign why we're getting a little closer to finding a bottom out of this really, really messy situation that we found ourselves in here with the stock market at least. All right. Wanted to check one more chart here, which is Where's the commodities 12 grid? There we go. I wanted to show you the commodities 12 grid here real briefly before we get into our trade idea. We looked at gold already. Gold is spiking, right? So gold is up. It's got a bullish posture now, breaking out above some of those key resistance areas. Silver does not have a bullish posture yet, but I would qualify today's price activity as being somewhat bullish. It was up 1.6% here today, and it kind of bounced off of that moving average. So it's trying to be more constructive. It doesn't look as strong as gold, but it's trying to go up. Remember, most stocks were down 2% or more today. So when you have something like silver that's actually up 1.6%, it's bucking the trend of what you're seeing in the stock market. Look at platinum. Platinum looks actually quite good. Platinum has been trying to establish this base here recently, bounced off this moving average, and look at where we closed on platinum. This is actually the highest closing price since going way back here to late July. And we closed above this double top formation right there. So platinum, in terms of PPLT, looks somewhat interesting there as well. So with that knowledge out of the way, with some of the strength there in the metals, I'm going to come over here to chart 4A, and I'm going to pull up a stock that is associated with the metals commodities, and that is ticker symbol RGLD. This is Royal Gold. Now, this is a gold royalty company, so it's a little bit different than the traditional mining companies that are out there, but it is starting to show us some interesting price developments. You'll notice that with today's robust move, and it was really robust. Remember, this is a stock. This is not a commodity. This is an actual company. And so for any stock in the stock market to be up 5.8% when most of the indexes were down over 2%, that's saying something. And so this one was up nicely here today. It was such a violent move up, as a matter of fact. You'll notice that it changed the posture overnight from weakly bearish to strongly bullish, just like that, with the snap of the fingers. And so that's a promising sign there as well. You'll notice that where we closed today was near the high of today's session, and this would be the highest closing price going back since this candle over here. There were a couple of these candles right in here where the intraday price was higher, but it never closed higher than where it closed here on today's close. So a lot of technicians would view that as very robust and bullish price action. And so what I thought we would do here today, now that volatility has really been spiking, is look at a option trade where we can take in some credit now that those volatility component of the pricing model is a little juicier than it may have been in the past. And so let's go on over here to the trade tab, and I'm going to take a peek here now at the, let's actually look at the 75 contract here. This is the one that has the delta of 29, and I'm looking at the November contracts, November monthly contract with 36 days until expiration. I'm looking at the $75 put, which is the 29 delta in this case, and I want to be the seller of that put. Now, as part of a bull put spread, you not only need a sold strike, you also need a bought strike, just in case you're just flat out wrong with your analysis. You know, if Royal Gold all of a sudden went down 10% tomorrow, we want to protect ourselves in a situation like that. So that's why we also construct these spread trades with a bought strike in there, where we're buying a put at 72.50 in this case as almost a built-in hedge in case this thing really spirals out of control in some sort of, you know, market meltdown type of event in the future. But right now we see bullish indications out of it. So I'm going to right click on the 75. I'm going to go to sell vertical. That loads up our trade down below. Notice I would receive 59 cents of credit for this. So remember, if you wanted to calculate your return on risk, you can click confirm and send right there. And I'm going to get my calculator out, and we can run the numbers. So $59 max profit divided by what we're risking in the trade, which is $191 max loss, and our return on risk is just up and over that 30% return on risk hurdle that we oftentimes shoot for. So we'll go ahead and place that as our trade application example here for the day. I'll show you real briefly on the chart that 75 on the chart would bring us to about right back here. So that would be kind of an area where we found some support and a bounce there yesterday. So let me come back on over here to the trade tab. And remember, it is earnings season, so you got to be careful. That was one of the conversations I was having in my Q&A session here today. But when we're doing a trade like this, you can be a little bit more confident with it because you do have defined risk. So if the stock were to blow up in your face on earnings, at least you've structured it this way as opposed to just buying the stock outright. So I'm going to go ahead and place this trade, confirm and send, review that one last time and send it on in. All right, well, I want to thank you for joining me here tonight. Remember, I'll be on vacation next week, so this will be the last time I see you for quite some time. That reminds me as well, I won't be doing the 9 at 9 and the dividend growth investing posts and some of those other things that you guys see me do on Twitter as well while I'm on vacation. So fear not, I'll be back the following week after that and get back in the saddle there. But, best of success to you. I hope you can navigate these markets nicely. David will be kind of taking the reins and helping you through some of those difficult markets here for the next week or so. So with that, I want to wish you all the best with your trades and your investments. Goodbye for now.